John, I want to come over to you. One thing I've been talking to a lot of traders about is the idea of Japanese bond yields rising and that becoming a more attractive place for Japanese investors to put their money and maybe even other Asian investors to put their money. Do you agree with that thesis?
Frank, I would think it's a little bit overblown at this point. The benchmark rate for Japan now at 75 basis points, that compares to ours. What's ours? 350 to 3.75, and our 10-year over 4%, and their 10-year at around 2%, if I'm correct. It doesn't look really like a big competitive attraction away from the U.S. Treasury. That said, we think it's a healthy move to diversification related to global investors. We don't see this as a dramatic negative for the U.S. If anything, when we see the U.S. currency weaken somewhat, although I think the yen actually weakened versus the dollar today on the news as it crossed the tape. Effectively, a dollar that's a bit cheaper than where it's been for the last couple of years is good for U.S. companies, and we are big exporters in terms of services, and it helps us be much more competitive.
But John, I totally understand that, but we are also talking about foreign money coming into the U.S. The idea of rate cuts coming up, and I think a lot of foreign investors are looking at the situation, whether it be Lisa Cook, a new Fed chair coming in, expecting to see more rate cuts and a more dovish Fed. Doesn't that set up the stage for a weaker dollar that may stop a lot of people from doing their hedges and carry trades and things like that? And again, another factor that could take money out of the U.S. and out of the U.S. markets?
I think, if anything, what we have seen is while central banks around the world are most certainly looking to compete against the dollar, some of that is related to the gold purchases we've seen over the course of the last year and a half, 2 years by central banks outside of the U.S. But in effect, the U.S. has the edge that the U.S. has is innovation, accountability, transparency, and governance. And what we see private investors and corporations still very interested in U.S. assets. This is foreign companies and foreign investors. We haven't seen anything that looks any kind of a sea change that would be detrimental to the U.S. And if anything, it sort of returns that, again, that global diversification of portfolios. As you know, I've been in this business 40-some years, 42 years. It ebbs and flows, and the one thing it's been the last few years, it's been so concentrated U.S. It's nice to see some diversification.
By the way, John, over those 42 years, I'm pretty sure you never used an abacus. I'm not going to let you off the hook, though. We got to talk about quadruple witching day. About $7 trillion in notional option exposure set to expire today. $5 trillion of that's tied to the S&P. Does that mean we're going to see some volatility? Does that in any way in your mind jeopardize the quote-unquote Santa Claus rally that I think a lot of people are hoping for to end out the year?
Yeah, I don't think it jeopardizes the Santa Claus rally because that even runs into the first few days of January. So we got a little bit of room to edge, not hedge, but edge in here for that Santa Claus rally. But we go through these witching Fridays on a regular basis, and thus far it's always going in. There's a bit of trepidation, but the market has been remarkably able to digest it. The liquidity in the U.S. market and the opportunities.